Welcome to Saving the Investor with certified financial planner, investment advisor, and insurance professional Alfie Townsend, president of Advantage Retirement Group.
As we say here at the Advantage Retirement Group, knowledge is power. And today we're going to talk a little bit about annuities. You know, David, the word annuity is such a bad word, it seems like, here in Southwest Florida. But the thing I always look at is you want to be educated, because there's some good ones and some bad ones, okay? I'm going to have you talk a little bit about, and you know, I've trained hundreds and hundreds of advisors on annuities. I started in the insurance back in 1983, so I know about them, but I want you to talk a little bit about the ones that give all of them a bad name, and then we'll dissect a couple of them in this short time.
Sure. So there's many different types of annuities, right? So you have start with a fixed annuity. So a fixed annuity is where you have a guaranteed rate for a guaranteed term. Okay, and typically, a lot of times there's not fees on those, depending on what carrier or product, but they're pretty straightforward. Yeah. You know, they're similar to a CD in a sense, but you know, obviously, annuities issued by an insurance company, of course. The annuity would be tax deferred, so that's a nice benefit.
Where CD, you have to pay taxes each and every year.
Exactly. So that would be the fixed. The next one would be like a variable annuity, where it goes up and down with the market. And typically, we've seen it, Alfie, high fees. High fees.
And I think that's the one, the variable annuity, David, is the one that gives all annuities the bad name.
Yeah, agreed. So that one you got to be careful of, and if you do have one,
those.
Right?
We don't do those.
We don't do those because it's too risky, high fees. Yeah. The next one would be a fixed index annuity, where it's sort of like a hybrid in between the two, where it's fixed in a sense where if the market does go down, you stay at zero, right? So you don't lose anything.
Because that's where the fix comes in.
Right, that's the fixed portion. And then, of course, if the market does go up, you participate in some of the gains in the form of a cap rate or a participation rate on an index such as the S&P 500. So that one, with a fixed index annuity, there's typically, some have no fees, some have very minimal fees. Yeah. And you can use them for income, you can use them for growth,
and I think, David, not to interrupt you, but the misconception of annuities is I get an annuity and then I die, it's over. Okay, so that's called an immediate annuity, where lifetime only, and we're not talking about that. We're talking about something that it would be a part of your portfolio, and the reason for it, we tend to use it to replace some of the bond portfolio. Mm-hmm. A bond risk number is about a 20 to 24. Mm-hmm. A risk number on this is like a savings account. It's a 1.
Right.
Okay, so that's where it could be a benefit for you. And right now, if you haven't really had a checkup on your annuities or life insurance, I will say it's the best time in probably the last 20 years, because interest rates have gone up, that you could get 2 to 3 times the interest that you're earning on your old one. So if you do have an old annuity or life insurance, this is a great time, because interest rates have gone up, but now they're going to start going down again. So give us a call to see if we can help you out. I'm Alfie Townsend, Southwest Florida's certified financial planner professional. My values are Main Street, not Wall Street. As an independent advisor, I don't work for shareholders, I work for you. If you want a fresh start with a local advisor, give me a call today.